Everyone is obsessed with artificial intelligence. Investors are chasing NVIDIA. Tech giants are racing to build larger and more powerful models. And every week, a new AI company seems to appear. But almost nobody is asking a much more important question. What makes all of this possible in the first place? Because before an AI model can answer a question, before a data center can train a model, before a GPU can power an AI system, something else has to happen first. There is an invisible layer of infrastructure that most people never see. Yet the entire AI industry depends on it. And at the center of that infrastructure sits a company that rarely makes headlines. A company that many investors have never even heard of. Synopsys. This isn't an AI company. It's the company helping build the tools that make the AI race possible. So today, let's answer one question. Why does almost every AI company depend on Synopsys? To understand Synopsys, we first need to understand how the AI economy is actually built. Most people only see the top layer. Applications like ChatGPT, Gemini, and Claude. But underneath those applications is an entire stack of infrastructure. AI models require enormous computing power. That computing power comes from massive data centers. Those data centers are filled with thousands of GPUs. But designing a modern GPU has become one of the most difficult engineering challenges in the world. Today's advanced AI chips contain tens of billions of transistors. Every single transistor must work perfectly with the others. Even a tiny design mistake could delay a product launch and cost hundreds of millions of dollars. This level of complexity is simply beyond human capability to manage manually. It requires highly specialized software. And that's where Synopsys becomes essential. In many ways, Synopsys isn't participating in the AI race. It's building the infrastructure underneath the race itself. Which is why understanding Synopsys means understanding one of the hidden foundations of the modern AI economy. So what exactly does Synopsys do? At its core, Synopsys builds the software engineers use to create semiconductors before they are manufactured. Think about the process of building a modern AI chip. Engineers don't immediately send a design to a factory. They first create a digital version of that chip. Then they simulate its performance. Test every connection. Verify that every component works properly. And search for potential errors long before manufacturing even begins. That's where Synopsys comes in. Its software helps engineers transform an idea into a manufacturable chip. But Synopsys doesn't manufacture chips. It doesn't own semiconductor factories. Instead, it provides the tools semiconductor companies rely on throughout the design process. And that process can take years to complete. By the time a chip reaches production, thousands of engineering decisions have already been made inside digital engineering environments. Without these tools, the process would become significantly slower, more expensive, and far more difficult to manage at scale. Which raises an important question. Why has designing modern chips become so difficult in the first place? To understand why these tools have become essential, we first need to understand what has happened to semiconductors over the past few decades. Early computer chips were relatively simple. Engineers could still understand most of the systems they were building. But that is no longer true today. Modern semiconductors have become some of the most complex products ever created. A single AI chip can contain tens of billions of transistors. Every transistor must work together with countless others. And even a small design error can have enormous consequences. If a flaw is discovered after manufacturing, an entire product launch could be delayed by months. And the financial impact could be substantial. The challenge is not simply the number of transistors. It's the enormous number of interactions between them. As chips become more advanced, complexity increases to a level that humans can no longer manage manually. Engineers now rely on sophisticated software to simulate performance, verify functionality, detect errors, and optimize designs before production begins. In many ways, these tools have become a foundational layer of modern semiconductor engineering. And their importance continues to grow as chips become more powerful every year. But another force is now accelerating this trend even further. Artificial intelligence. Because the AI race is no longer just a software race. It's becoming a race to build ever more powerful chips. And that changes everything. Artificial intelligence is creating a new kind of competition. At first, many people believed the AI race would be fought primarily through software. Bigger models. Smarter algorithms. Better applications. But increasingly, the competition is shifting toward hardware. Because every breakthrough in AI requires more computing power. And more computing power requires more advanced chips. This is why some of the world's largest technology companies are now investing heavily in custom silicon. They are no longer relying entirely on off-the-shelf solutions. Instead, they're designing chips optimized for their own workloads. Every company has different priorities. But they all share the same objective. To build faster, more efficient, and more powerful AI systems. And regardless of their strategy, they all face the same challenge. Building advanced semiconductors has become extraordinarily difficult. Every new generation of AI pushes the boundaries of engineering even further. More performance. More efficiency. More complexity. And every increase in complexity creates more work inside the chip design process. This is why the AI boom isn't only creating demand for AI applications. It's also increasing demand for the infrastructure required to build the next generation of chips. In other words, the AI race is quietly becoming a chip race. And every new AI breakthrough may create more work for the companies building the infrastructure behind semiconductor development. But another question naturally follows. If these tools are so important, why don't customers simply switch to another provider? The answer lies in one of Synopsys' biggest strengths. Switching costs. By now, a natural question emerges. If these tools are so important, why don't companies simply adopt another provider? The answer is more complicated than it may seem. Designing advanced semiconductors is not a project that takes weeks. It often takes years. Thousands of engineers may be involved throughout the process. Over time, entire engineering organizations become deeply integrated around a specific set of tools. Teams are trained to use them. Internal workflows are built around them. Validation procedures depend on them. And countless engineering decisions are made inside those environments. Replacing those tools is not like changing an Office application. It can require retraining engineers, rebuilding established workflows, and introducing new sources of risk. More importantly, any disruption could delay the launch of an entire chip program. And in an industry where timing matters, delays can be extremely expensive. This is why companies tend to stay with providers they already trust. Not because change is impossible, but because the cost of change can be extraordinarily high. In many ways, introducing a new tool also means introducing uncertainty into one of the most complex engineering processes in the world. And most companies would rather avoid that uncertainty altogether. This creates a powerful advantage for companies that have already become deeply embedded inside their customers' operations. And that advantage becomes even more valuable as chips continue to grow more sophisticated. But switching costs alone do not explain Synopsys' position. To understand that, we need to look at the business itself. By now, we've seen why customers tend to stay with the tools they already know. But that raises another important question. Why don't more competitors simply build a better alternative? The answer lies in the nature of the semiconductor industry itself. This is one of the most demanding engineering environments in the world. Customers don't just need software that works. They need software that has been proven to work reliably over time. Every new generation of chips introduces new technical challenges. And solving those challenges requires years of research, engineering expertise, and continuous investment. Building these capabilities is neither quick nor inexpensive. But sophisticated software alone is not enough. Over the years, semiconductor companies have built entire ecosystems around established workflows. Engineers are trained on them. Internal processes depend on them. And teams across different organizations have learned to work together using common tools and standards. Replicating that ecosystem is extraordinarily difficult. A new competitor would not only have to build sophisticated software. It would also need to convince customers to change deeply embedded engineering processes. And that is something that rarely happens overnight. This combination of technical expertise, long-term industry relationships, and integrated workflows creates meaningful barriers to entry. It doesn't guarantee permanent leadership. But it does make competition exceptionally difficult. And those advantages may become even more valuable as the demand for advanced semiconductors continues to grow. Which naturally leads to another question. If Synopsys occupies such a strategic position within this ecosystem, how does the company actually make money? So far, we've explored why Synopsys occupies such a strategic position within the semiconductor ecosystem. But how does the company actually make money? The answer lies in three businesses that support different stages of the technology development process. The first and most important is electronic design automation, or EDA. This is the core of Synopsys. It provides the software engineers use throughout the semiconductor development process. The second business is semiconductor IP. Instead of designing every component from scratch, customers can license pre-built building blocks that have already been tested and validated. This allows them to shorten development cycles and reduce complexity. The third business is software integrity. This segment helps companies improve the quality, reliability, and security of their software. Together, these businesses create multiple sources of revenue. But they don't all play the same role. EDA remains the foundation of the company. Semiconductor IP reinforces its position within the semiconductor ecosystem. And software integrity adds another layer of diversification. More importantly, many of these businesses benefit from long-term customer relationships and recurring demand. As semiconductor development becomes more sophisticated, customers often continue investing in the same platforms and workflows over time. That creates a level of predictability that investors tend to value highly. Because when recurring demand is combined with deep customer integration, a business can become far more resilient over time. And that naturally leads to another question. Do the financials reflect that strength? So far, we've built a case for why Synopsys occupies such an important position within the semiconductor ecosystem. But every investment thesis eventually faces the same test. Do the numbers support the story? Because a compelling narrative alone is never enough. strong fundamentals must support it over time. And this is where Synopsys becomes particularly interesting. Many of the advantages we've discussed throughout this video often show up in the financials. Long-term customer relationships can create recurring demand. Deep integration can create a level of predictability that is relatively uncommon in the technology sector. And predictable revenue often gives companies greater flexibility to invest for the future. But investors should avoid focusing on a single year of results. The bigger picture matters. Has the company consistently grown its revenue? Has it maintained healthy profitability? Does it generate strong cash flow? And can it continue investing heavily in research and development without weakening its financial position? These are some of the questions that help separate durable companies from temporary winners. Of course, no company is immune to industry cycles. Semiconductor spending can rise and fall over time. But companies with deeply embedded customer relationships often navigate those cycles more effectively. Ultimately, the financials help answer one simple question. Can this company continue creating value over long periods of time? And if the answer is yes, investors face an entirely different challenge. How much are they willing to pay for that quality? By this point, we've established why Synopsys occupies such an important position within the semiconductor ecosystem. But even great companies can become poor investments if the price is too high. Which brings us to a critical question. Is Synopsys worth the price? There is no simple answer. Because valuing a company like Synopsys is not about finding a cheap stock. It's about deciding how much you're willing to pay for quality. Companies with durable advantages often trade at premium valuations. But premium valuations also come with premium expectations. The market is not paying for what the company is today. It's paying for what the company may become in the future. And that creates a challenge. If growth slows, even exceptional companies can go through long periods of disappointing returns. This is why valuation always matters. Instead of asking whether the stock is cheap, a better question may be this. Are the company's long-term advantages strong enough to justify a premium price? Because the market is ultimately making a bet that advanced semiconductors will continue to become more important. That AI will continue to demand more computing power. And that companies deeply embedded within this ecosystem will continue to benefit. Of course, none of these outcomes are guaranteed. Every investment involves uncertainty. But if these long-term trends persist, Synopsys may remain one of the most strategically important companies behind the AI revolution. And that brings us to the final investment thesis. By this point, we've discussed the business, its competitive advantages, and its financial strength. But investors still face one practical question. Where does fair value actually sit? The answer is never a single number. Because valuation is ultimately an exercise in probabilities, not certainty. That's why I prefer to look at multiple scenarios rather than one fixed estimate. A conservative scenario assumes slower growth and more cautious market expectations. A historical scenario assumes the company continues to perform in line with its long-term track record. And an optimistic scenario assumes Synopsys benefits from a prolonged expansion in AI and semiconductor demand. None of these outcomes are guarantees. They are simply different ways of thinking about the future. Because investing is not about predicting the future with precision. It's about understanding the range of possible outcomes and comparing them to today's price. Ultimately, valuation is where business quality meets market expectations. And that may be the most important distinction long-term investors can make. Because even exceptional companies can become disappointing investments if expectations become too optimistic. On the other hand, periods of market pessimism can sometimes create opportunities to accumulate great businesses at more attractive prices. And that's why valuation should never be viewed as a prediction. It should be viewed as a framework for decision-making. Which brings us to the final investment thesis. Throughout this video, we've seen how artificial intelligence is increasing the demand for more powerful semiconductors. We've seen how chip design has become extraordinarily complex. And we've seen why specialized software has become an essential part of that process. But perhaps the most important takeaway is this. Synopsys is not trying to become the next AI champion. It is helping others build the future of AI. Every new generation of chips requires more computing power. More computing power creates more complexity. And more complexity increases the importance of the tools used to design those chips. This may become one of the defining trends of the next decade. Of course, no company is guaranteed to remain a leader forever. Technology evolves. Competition intensifies. And expectations can sometimes become too optimistic. But if semiconductors continue to grow in importance, the need for trusted design software may grow alongside them. And that places Synopsys in a uniquely strategic position. Sometimes, the most valuable companies are not the ones everyone is talking about. They are the companies quietly enabling entire industries to move forward. And that may be exactly what Synopsys has become. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching, and if you enjoyed this analysis, don't forget to like, subscribe, and share your thoughts in the comments below.